The Tom Woods Show, episode 540.
Prepare to set fire to the index card of allowable opinion. Your daily dose of liberty education starts here. The Tom Woods Show.
Want to know an easy way to be a hero to all your libertarian friends and relatives? With a gift subscription to libertyclassroom.com, where they can learn the history and economics they didn't get in school. Watch for a special Black Friday discount. Welcome to another episode of the Tom Woods Show. Again, I'm sorry this one was a little slow in coming. Again, as I said, I did so many episodes in advance that it was hard for me to get in there with some current events. So this is going to take us back a little bit. Let's see, this is going to be November 24th, 2015. So this is from a couple of weeks ago, the topic we're going to be talking about. During the most recent GOP debate, Rand Paul had some negative things to say about the Federal Reserve. And the very next day, a website called Vox immediately jumped and said, how dare he say these things, why the Fed has done wonderful things, and what Rand Paul has to say is all wrong, and so on and so forth. And I had a lot of people saying, we need you to answer this article. And I'm sorry it's taken so long. I'm going to get better at figuring out how to insert a current events sort of episode into the stream of episodes. But anyway, I'm going to be talking today to Dave Howden, who's been a guest a couple of times on the show in the past. Dave is the chairman of the Department of Business and Economics at the Madrid campus of St. Louis University. And I met him when he was a Mises Fellow. I really think he's one of the best and brightest Austrian economists we have anywhere in the world today. So I'm always glad to have a chance to talk to him. So let's do that. And again, as I say, I'm sorry for the delay, but here's the knowledge you'll need for the next time this happens, because something tells me this is not the last time such an article will be written. Dave Howden, welcome to the show.
Hey, Tom. Thanks.
I just apologize to everybody for being so late getting to this column, but that's the way it goes, and I'll try to do a better job. But I'm going to link to it, as usual, at this will be tomwoods.com/540. And I thought you and I might go through, and by you and I mean you, might go through this column and see what's wrong with it. Rand said that the Fed has been harming the poor, and he gave as a sort of classic example of this the fact that people's cost of living is going up because the prices that they pay are going up for the various goods that they buy. So there are three primary criticisms of the monologue that Rand delivered in the debate about the Fed that we encounter in this article. And the first one is, well, first of all, inflation is super low in the United States. The problem for Rand Paul's argument is that the Fed has actually yielded us below average inflation, that we've had an average inflation rate of about 1.4% a year. This is actually below their 2% annual target. It's the least inflationary period of the past half century. So who other than an ideological, who other than a crank would be worried about price inflation? I ask you, Dave Howden.
Yeah, of course.
Not because you're a crank.
Yeah, of course. And, this is a funny one because it's inflation is supposedly so low right now, and just one of the other benefits that is accruing to people is that interest rates are super low. And then, for your average guy on the street, I think he looks around and he looks at normal prices, or he goes to the grocery store, and inflation doesn't exactly seem to be very low. Actually, do you know what? Do you remember this was a bigger deal a couple years ago when people were talking about stealth inflation, and the conversation was that prices aren't necessarily increasing by much, but stores are selling smaller quantities. Do you remember this?
Yeah.
And I was home. I was just visiting my parents last week, and I forget. I took something out of the cupboard, and it was a really strange size. And I said, "Why?" I asked my mother. Why is this 400 grams instead of 500 grams or something? And she said, "Well, that's the size that they sell now." And I thought, well, isn't this funny? And then she made a snarky comment, but they sell it for the same price. And so we've got all these examples of the fact that inflation is actually quite a bit higher than what the official statistics suggest. It's only masked a little bit because stores are trying to hide it by reducing sizes instead of increasing prices and things of that nature. Or another good example that you could look at to question whether price inflation is actually as tame as what you'd think is to take a good look at the stock market. Like since 2008, stocks have been performing pretty good by any measure, I would say. And notwithstanding, a little hiccup that we had a couple months ago, they're back to pretty close to their all-time highs. And this doesn't seem to coincide with the narrative of price inflation being incredibly low. It might be for some things, but for a lot of important things that are included from the statistic, like stock prices or housing prices are underrepresented, or the massed inflation that we have in a lot of consumers' goods, inflation for your average Joe or Jill out there is a lot higher than what you'd think.
I also think, given how much more productive I can be, and by extension, many other people can be, given the tremendous growth in productivity related to the internet, that prices should actually be falling. I mean, when you consider how much I can accomplish in one day, given I have programs that I can run my social media with one click, I can make sure that the 10 minutes that I'm standing in line, I'm writing memos to people. I mean, I'm able to be productive over the course of the day. I'm able to contact people immediately, have webinars, get an enormous amount done in what would have taken me a week before. This must be yielding greater physical output per personal input. And so I should expect to see prices falling through the floor. And instead, I'm supposed to be dancing a jig that they're only 1.4% higher?
It's funny because the new baseline for price inflation is 0, as if you could never ever have prices falling. But like you're getting at, the normal state of affairs that you would have in an economy with a constant monetary base, so without a central bank, let's say, and productivity increases every year that are increasing the amount of goods and services that we produce, is for mild or gentle price deflation, which America had, for example, in a lot of the late 19th century. And it was not harmful to growth. It was the result of a very robust, very positive economic period in the States, where the supply of goods was increasing so quickly, and a central bank wasn't there to just paper over it by increasing the money supply. So whenever you read these articles, the narratives change now as if you could never ever have price deflation. And of course, it's such a terrible thing, everybody wants to say, and they refuse to ignore that. No, price deflation is actually a healthy indicator that the economy is robust and humming along nicely. Price inflation, in contrast, would be caused by either the money supply increasing too quickly or by the amount of goods and services we're producing decreasing. And I don't think you'd find too many people that would say either of those things in and of themselves are positive.
Absolutely. In fact, the way I have sometimes thought of it, and I know I can't even remember where I got this, but when we think about what capitalism is really doing, is trying to do the best job possible to alleviate the scarcity that is an inherent part of the world we live in. And the reflection of that alleviation of scarcity is falling prices, that things are more abundant, they're easier for us to get. And so the ultimate goal that the market is ultimately aiming at really is for prices to all be zero, that we would ultimately have conquered scarcity. Now, we're never going to get to that point, but that's its natural condition, is to be alleviating scarcity. So we should be very pleased when prices fall. Now, I know that, as you say, the conventional wisdom is we're supposed to fear deflation. I'm going to link at tomwoods.com/540 to 2 episodes I've done on deflation, one just by myself and one with Philip Bagas, your friend over there in Spain, who's written quite a bit on deflation. Also, even if price inflation for consumer goods is relatively low by historical standards, it compounds over the years, so that I still can't, it's not so low that I could retire by saving a whole bunch of dollar bills and then going to Florida and whittling them away the rest of my life. I would still be ruined if I pursued that policy, even with these so-called low inflation rates.
Absolutely. In fact, people often miss this fact that what kills or what debases a currency is not just the rate of inflation, but it's also the fact that it compounds over the years. So the US dollar today is worth, maybe 2% of what it was worth when the Federal Reserve was formed 100 years ago, maybe only 1% as much. And most people, I think, or the conventional wisdom wants to look at the highly inflationary period in the late 70s, very early 80s as the culprit for that it was those few years of runaway inflation that really decimated the dollar. When in fact, no, it was 100 years or decade after decade of relatively mild price inflation that just constantly dwindled, chipped away at it until we were stuck with what we have today.
Let's move on to the second of the claims here. Low interest rates can be good for ordinary people. Now, in this section, of course, there is no reflection of any understanding of the business cycle at all. It's just, well, you have a choice. You can either have high interest rates or low interest rates, and we all know low interest rates can be good for ordinary people. It's like saying low milk prices can be good for ordinary people. Well, no doubt they can. But you can't just bring them about through brute force. There are consequences to this. The economy is an interrelated lattice work. You can't just make one little change through violence and say, look, everybody's been made better off. So we read in this section that Rand Paul supposedly ignores the fact that ordinary people don't just save money, they borrow it too. Well, how about that? I love how we're treated like we're seven, If you've bought a house in the past few years, can you believe they have the nerve to bring up housing of all things in connection with this? No sense of irony at all here. If you've bought a house in the past few years, you probably benefited from today's exceptionally low interest rates. If you bought a house 10 or 20 years ago, you probably benefited from being able to refinance your mortgage at a lower interest rate. So what's wrong with that, Dave Howden? Low interest rates, good for ordinary people.
Implicit in this whole discussion about, and not just this discussion because it's prevalent, everywhere you turn, that low interest rates are great for ordinary people. And implicit in this is that ordinary people should be net debtors and not net savers. So in the opening line that you just quote, they say, Rand Paul ignores the fact that ordinary people don't just save, but they borrow money too. And of course, if you're a borrower, okay, on the face of it, we would prefer to pay lower interest rates than higher interest rates. But the goal, if you want to call it a goal, shouldn't be getting people to borrow as much money at low interest rates as possible. You'd think the goal is to try to get people to save as much money and invest it in productive enterprise so that we can get the economy growing at the best rate possible. So, of course, when we drop interest rates down to where they are today at zero, let's say, what's the motivation for anybody to save money? And there is none. So, of course, everybody goes out, consumes on frivolous things and many pointless things, or buys houses and runs up debt. And this is supposed to be a positive thing. Now, then we get to the business cycle aspects, which, of course, there's, not very well understood yet. And people don't see the connection between low interest rates motivating people to borrow and the forces that this puts in motion that result in the business cycle and the Austrian business cycle, to be specific. So, after 2008, we had that bust. And immediately after it happened, there was a lot of understanding that it was caused by, Austrians understood it perfectly, right? And your book, Meltdown, hits the nail on the head, that it's caused by low interest rates enticing people in the States or anywhere to invest in longer dated investment projects or for example, buy a house, as that's a long dated investment project. And even the mainstream, they kind of recognized this as well. And they said, well, the problem in 2008 and 2007 was low interest rates caused debt levels to be too high, and people couldn't shoulder the repayments any longer. This was a fairly common enough mainstream way of looking at it. But now we're fast forwarded, how many years? 7 years on here, and people have forgotten this wisdom that was learned in the immediate aftermath. Like, we went through all that pain and hardship for nothing. And now people are looking back at interest rates and saying, no, these low interest rates and the fact that people can borrow and go into debt are a positive thing. And so this article goes on to say that, Rand Paul for calling the Fed out on this conventional quote unquote wisdom that low interest rates are great for people who are in debt. That's terrible.
I have a couple things to say to that. A lot of times, we get told, as you say, that low interest rates are great, people can borrow more easily, but the very same people will turn around and say Americans are in too much debt, and then they'll blame capitalism for that somehow. Mm-hmm. But, it's the same. So The good side, which is that people can borrow cheaply, the Fed gets credit for. The bad side, people are way in over their heads in debt, is somehow some invisible force of the free market. Inexplicable, but probably capitalism's fault. Now, another point of this, let me get back to let's get the article back up here.
Well, here, Tom, I'll tell you, you can have low interest rates that are great for people who borrow it, and here's how you get them. Just save money. People save money, which causes interest rates to fall as the supply of savings increases. And then there's actually resources available from these savers to be borrowed from those who want to invest it in the present. This is how you get positive economic growth. But of course, nobody wants to say the unfortunate fact that nobody wants to discuss is that interest rates, savings, I should say, are the result of people not consuming. Nobody wants to recognize that there has to be some pain in order to have savings available for interest rates to be low for positive reasons. And instead, everybody is looking for a free lunch and saying, no, the Fed can just print up a bunch of money and that'll drive interest rates through the roof. The supply of monetary savings will increase, and this will be positive for everybody who wants to borrow. But nobody wants to look at the true story or the real story, which is, no, if you want to have savings increasing in a sustainable way so that low interest rates result, those people need to be curtailing consumption. They need to not be buying the new car this year, or they need to buy a house which is a little bit smaller, or not buying a house, or not buying a new winter outfit this fall.
Well, it's funny you say that. That was exactly my second point, because it comes up in the second paragraph of this section where the person, and this is very revealing about how uninformed this writer is, if the level of the argument wasn't indicative enough. The fact that he goes on to say, people used to understand that low interest rates are good for ordinary people. Back in the 1990s, politicians would frequently argue that we needed to cut the deficit in order to bring interest rates down. So he treats that as if that's the same thing as the Fed pushing interest rates down, because they have the same outcome. Interest rates go down. Mm-hmm. But of course you should cut the deficit to bring interest rate. So there's nothing wrong with that argument.
Actually, when you have actually, out of all the reasons you should cut the deficit, probably the interest rate one is the last one. You should cut the deficit to get rid of all the bloat.
Well, that's true. That's true. But if federal spending is crowding out investment and all that, yeah, you're right. There are a million reasons to do it. But the point is that would be a totally benign way to push interest rates down, and yet he thinks they're all the same. He can't see the difference between the Fed doing it artificially and the federal government simply not intervening in the economy so much, not using up so many resources, not using up so much capital that could have been used for investment. Now, his last paragraph in this section involves people who are saving for retirement. He says, anybody who's saving for retirement by putting cash in a savings account is making a big mistake, whether interest rates are currently high or low. Experts advise people to put their retirement savings into a diversified portfolio of stocks and bonds. All right, now we got him. Because experts 100 years ago were not advising people to make such a boneheaded decision. Oh, yeah, go into stocks and bonds that you know nothing about because history says that they'll perform well. Well, it depends on what slice of years you're talking about. Mm-hmm. Maybe they won't perform well. But to the contrary, in the past, when you had a precious metal monetary system and the precious metals were the money, they weren't just some inflation hedge, but they were the money. Because they gained in value all the time, you could just save them. You could just accumulate them. You didn't have to have a diversified portfolio of stocks and bonds. And putting cash in a, quote, savings account wasn't making a big mistake. It was a perfectly normal thing to do. But because of the monetary system this guy himself favors, people don't have that option anymore. Where am I wrong on that?
One of the things that economists like to talk about is the inflation tax. And this idea that inflation imposes costs on people. Mainstream economists talk about this as well. And, here's a really good example of it. We have a whole industry in the sense of stock and bond market and analysts and experts, quote unquote, who advise people to put their retirement savings into stocks and bonds that really are a relatively recent phenomenon because people historically under sound monetary systems or gold standards or what have you, never had to do this. They could put their money in a savings account at a piddly little interest rate or even no interest rate, and mild price deflation would take care of the rest. That would provide the return that people needed in order to provide for their retirements. And it's only today when interest rates are so low that you have a whole industry out there of people saying, no, you need to put your money into stocks and bonds because those are the only things that are making a return which is sufficient enough now that you'll be able to have enough for your retirement in the future. And like you say, it really depends on what kind of historical period you're looking at. Like even in recent history, if you had listened to these experts and put your money in the stock market in the summer of 2007, that was before the crisis, it took you right up until basically 2 years ago, more or less, to make your money back. And that's just in nominal terms. That's not even accounting for inflation. So you had to wait 6 years if you did that just to break even on your investment. And if you go back to, say, the 20s, you had to wait almost 2 decades in order to make your money back. So the period that you're looking at really matters. And I think it's, for starters, really foolish to say that right now, to say, go and put your money in a diversified portfolio, after stocks have, in the States, have more than doubled in value over the last 5 years. And also, it promotes this mindset that we need a whole industry to help people make sound investments, when in the past there was just no demand for this because you could take care of it through simpler ways like savings accounts.
Right. This is not an advance. There's no reason to cheer something like this. Finally, the third section, he actually is not making the point that I think you and I thought he might be making when we first saw the subheading that said, the Fed has less control over interest rates than you think. He wasn't arguing that actually there are other forces that have more influence on interest rates. That's not his claim. What he's saying is, think of a guy, I don't want anybody to think these are my words. These are his words. Think of a guy driving along a winding mountain road. In one sense, he has total control over where the car goes. If he turns the steering wheel to the right, the car goes right. But that doesn't mean he can drive the car wherever he wants. If he steers too far to the right, he'll go through the guardrail and off the cliff. If he steers too far to the left, he'll run into the mountain on the other side of the road. The Fed is in a similar situation. It's trying to steer a course between the twin evils of inflation and recession. If it keeps rates too low for too long, the economy will start to overheat, and inflation will get out of control. If the Fed raises rates too quickly, it'll tip the economy back into recession. So it's true that at any particular instant, the Fed can make interest rates go up and down. But the Fed doesn't have that much leeway to raise rates if it wants to avoid hurtling over the cliff and into a big recession. So that's his point. Mm-hmm. And so for a second, I thought he might have some insight, and now I see that, and it's just not good at all.
Yeah, you make the assumption that the Fed is on the right road to begin with. That's implicit in this whole thing, that the Fed is on this road that it chose, and it's the correct road, and now it has these choices, the choices that he says between the twin evils, quote unquote, of inflation and recession, which we'll get to that in a minute. But what about if the Fed was on the wrong road to begin with because of where it drove us to in the past? Like, it's done something in the past, and now, let me kind of paraphrase what I think Janet Yellen and the Federal Reserve governors are thinking right now, is that they understand that there was a problem caused in the past, and at root, it has something to do with lax credit conditions and low interest rates, which the Fed, under a different governor, Bernanke or Greenspan, if you want to go back far enough, was responsible for. But that's neither here nor there, because now there's a problem, and they've got to steer us out of this problem, and they see the solution as being further low interest rates. They're scared to hike rates because it's going to hurt students who are in debt, and homeowners who are up to their eyeballs in mortgage debt, and the government who's even more than its eyeballs up, in debt. And so they see the road that they're on as being, they don't question it, right? It's not really questioned that we got into this problem by low interest rates such that we should not continue this policy going forward. Because if they actually thought that, they'd say, okay, let's take our lumps now. Let's let interest rates reset to where they should be and get us off this road. And it might be painful, but at least then we'll be on, the analogy is getting a little bit old, but at least then we'll be on the road to sustainable growth or a sound monetary system or something like that. But by keeping the old policy going, they make this tacit admission that no, we should be on this low interest rate road, and it's got its own problems, but that's where we're firmly committed to driving.
Can you just take a minute to explain, because I'm quite sure Timothy Lee doesn't understand it, and maybe even some listeners don't quite understand it, what exactly is the problem with having a low interest rate policy by the Fed. What does that do? Why is there something that's unsustainable that's set in motion by that? Why isn't it all just flowers and lollipops everywhere?
The problem, you could say it's twofold. And on the one hand, people understand that, and we've discussed it a little bit, that the low interest rate policy from the Fed demotivates savings and motivates people to go into debt. This is a very superficial problem. So, okay, young people today don't want to save, or middle-aged people don't want to save all that much because the returns are so low, but they want to go out and borrow. So they're going to buy that new home, and they're going to buy the new car, and they're going to take on a mortgage or a consumer loan in order to do so. That problem is fairly common, I think, to most people, but I don't think that's the biggest problem. And the nub and kernel of the Austrian business cycle theory gets down to it, and that is that the interest rate itself, and it's a price, it's an intertemporal price that compares present to future consumption. But the interest rate itself, because it's a price, it sends signals to consumers and producers about not what they should be producing, like normal prices do, but when they should be producing. So, for example, a normal store, let's say a clothing store like the Gap, if the price of T-shirts, the price of sweaters is going up because it's wintertime and it's cold, and that signals to them that they should be producing more sweaters in preparation for the winter season. Well, the interest rate sends them a signal as well, and when interest rates fall, it makes things in the future much more valuable in the present. So the signal that this low interest rate sends to a company like the Gap is that it should start doing longer dated investment projects. And by that, what I mean is an investment project that won't mature or won't turn profitable until a period of time further in the future. And in many cases, you can be duped, maybe for lack of a better word, but I think it's pretty apt. You can be duped into making investments which are so long dated that they'll never pay off. They'll never be profitable. And so because they don't pay off, businesses are in this jam where they've made long-term investments and they've made expenditure today, but they're never going to pay off in the future. A good example of this would be a lot of tech companies that have no earnings and probably have no hope of ever making earnings, like Pinterest or LinkedIn or something like that would be a good example. They've done long-term investments that will never ever pay off. And so the money has been squandered today. And the low interest rates, they mask over this problem in the short term, but they don't erase or eradicate the fact that people are forced into making mistakes about when investments should be undertaken. Not what type of investments in particular, although there's some of that going on, but more the big problem is how long should the maturity of the investments we're entering into be.
I want to say one last thing. That's exactly it. And so this time dimension gets screwed up. That's what interest rates are all about. I'm going to link to the episode a long time ago in which you joined me to talk about the business cycle. That'll also be at tomwoods.com/540. But let's just finish up with the last bit here where he talks about the European Central Bank. He says the ECB did exactly that. That is, it raised interest rates too high and so on. He says, when it raised interest rates prematurely in 2011, that proved to be a huge mistake because it tipped the Eurozone economy into a double-dip recession. Countries like Greece and Spain are still feeling the pain today. A key thing to notice here is that the ECB didn't just damage Europe's economy with its interest rate hike. It wasn't able to keep interest rates up for very long. Before the end of the year, it became obvious that the higher rates were hurting the economy. The ECB was forced to reverse itself and return interest rates to their previous level. And he says today rates are even lower than they were in 2011, and that year's premature interest rate hike is part of the reason. What do you say to that? Again, this just strikes me as extremely simplistic. What's your response to that analysis?
Well, for your listeners that don't know, I live in Madrid, Spain. And I always think it's funny because the life I live here has little connection to the life that I read about, that I supposedly am living, that I read in the newspapers back in the States. Now, I've got a couple comments about this. The first is Europe has got lots of problems, but the ECB is pretty far down on the list of those problems. The bigger problem is bloated government sectors, high deficits, growing public debt levels, and things of that nature. For example, since the article wants to bring up Greece, because that's the worst case scenario over here. Greece's problems are not caused in any way whatsoever by the euro. They're caused by having a completely ineffective public sector that costs a lot of money. And they're caused by having high deficits, which, okay, maybe then you could say the ECB, if it just kept interest rates down for a little while longer, it would have helped the Greek government pay off its debt. But that's not the ECB's problem. That's the Greek government's problem. They shouldn't have taken on so much debt to begin with. And incidentally, the only reason they took on as much debt as they did was because the ECB had fostered a low interest rate environment to begin with. So it's I don't understand where all this hatred for the ECB comes from when people talk about European problems, because most of them are homegrown problems in their respective countries caused by a lot of labor regulations, inflexible countries. It's hard to fire people, which makes people hard to hire in the first place, or governments that are just overly expensive and not good value for the money, if I could use such a term to describe the government. And on the other hand, you should note that the ECB dropped interest rates again in Europe, but I don't necessarily think that this is such a good thing. If you look at most of the beleaguered European economies in the aftermath of the crisis in 2008, there's a lot of reason to be optimistic. There was a lot of problems that got sorted early on, like the banking system collapsed in many countries, and there was a lot of shaky financial institutions that went under and weren't saved like they were in the States. And the ECB now is dropping interest rates, and it's kind of reversing course. Now it's allowing a lot more of these shaky institutions to maintain themselves instead of letting them die away. For example, go up to Germany right now. Germany's been the success story of almost the whole world over the last 6 or 7 years, and unemployment is as low there as it's been since it reunified. And now in Germany, there's a lot of talk about the economy being overheated, that maybe there's a housing boom brewing and things like this. And the housing boom, if there is one brewing in that country, you cannot discuss that without making reference to the interest rate policy of the ECB and the fact that it has dropped interest rates quite recently, and that in a lot of Europe you have really record, even by American standards, really record low, or in some countries, negative interest rates. So the whole fact that the ECB dropped interest rates starting in 2011, and that is indicative of the fact that they knew they were doing something wrong before, or they admit that they made a mistake before by keeping interest rates too high. That's a wrong way of looking at it. A better way to look at it would be, no, since 2011 and interest rates falling lower and lower, there's been new problems developing in Europe that will be exposed someday in the future, as they will be in the States, I'm sure. But they were really caused by the change in course in 2011. And if the ECB had have stayed the course that it had before of keeping interest rates higher to motivate savings again, to get people to quit consuming and increase the amount of real savings, the recovery in Europe would have continued and probably would have continued more robustly than it has in the past years.
Dave, before I let you go, I want to just ask you, what would you recommend people read so that they would be more informed on how to think about these sorts of questions, more informed, say, than the author of this article?
Well, if you want the question about interest rates and inflation, actually, since we talked about deflation and how falling prices are such a beneficial aspect, Philip Bagas, who you mentioned already, has a beautiful little book that came out last year on deflation, and he uncovers all of the myths about deflation and discusses some new aspects about why it's beneficial, new aspects that people hadn't really discussed before. And I think as a handy little primer that's easy to read and gives people really the true facts without being too technical, that is the best reading on it.
All right, that's very good. I will link to it at tomwoods.com/540. Dave, always a pleasure to talk to you. I think this article is just over. It's all gone. I wish we could have been more timely with it, but better late than never. I can't thank you enough for coming here and talking to us today.
Thank you, Tom. Pleasure is all mine.
All right, of course, tomwoods.com/540 is the show notes page for today. I have a few things to tell you about. The first is the trash talking that's going on Twitter between Michael Malice and me. If you're a longtime listener of the show, you know that there's a big debate coming up in New York City, December 3rd. Details at tomwoods.com/events between Michael Malice and me. and we are debating the legacy of Alexander Hamilton. Inexplicably, Malice is pro-Hamilton, and I am anti-Hamilton. And that means he's arguing in the affirmative, and I'm arguing against the resolution. And it's an Oxford-style debate, so that means there is going to be a clear winner. That is to say, it won't be a matter of, well, I feel like this guy was better. No. They poll the audience before the debate, and then they poll the audience after the debate. And you see how many minds have been changed. And the more minds are changed, whoever changes more minds is declared the winner. Dave Smith, the comedian we talked to on a previous episode, will be opening the debate with a stand-up routine, so it's just going to be fantastic. New York City, December 3rd. Well, anyway, Malice is just piling on. Maybe the biggest of the low blows was when he said that Bill Kristol predicted I would win the debate. Now you know I'm going to lose. That was good. That was a good one. If Bill Kristol predicts something, we all know, you see, it doesn't come true. So it's just crazy. And once in a while, we do have a cooling down period, and then bang, all of a sudden, back and forth between Malice and me. So if you're not following me on Twitter, look at what you're missing out on. Come on now. I am at Thomas E. Woods, so go ahead and follow me on Twitter. A few things coming up on Black Friday. I will be reminding you about this, and I've got a special announcement for next Monday, for Cyber Monday, November 30th, 2015. So here we go. Black Friday, huge deal on Liberty Classroom as a gift to give to all your libertarian friends and relatives. LibertyClassroom.com. It's awesome, right? These are people who want to know the truth, and life is just taking up too much of their time, and they're frustrated, and they want to win debates and smack down the bad guys. You can learn everything you need to know in courses you can listen to in your car on economics, on history, and a lot more, taught by me and other great people. So check that out at libertyclassroom.com on Black Friday. Secondly, Rocket Languages. If you know people who want to learn a foreign language, well, they're having a 60% off deal on Black Friday. I know about that because I'm an affiliate of Rocket Languages, but nobody else knows that. So I'm telling you. Maybe I'm not supposed to. I don't even know. Maybe they're going to kick me out. I have no idea. But I'm telling you that Black Friday, go there and hurry up and buy some language courses because they're cutting them down to 60% off only for the first 1,000 that sell. So you've got to get in there right away on Black Friday using tomwoods.com/rocket. But finally, you know how I talk about starting your website and I can get you a cheap price on web hosting and all that? Well, Bluehost is having a huge discount. On Black Friday, they're having a discount, and over the weekend, they're having a discount. But what I'm going to tell you is the biggest discount comes on Cyber Monday, November 30th, the Monday after Black Friday. That's when they're lowering their hosting prices all the way down to just $2.95 a month. And that's even lower than I can usually get it for you as a VIP affiliate of Bluehost. $2.95 a month only on Cyber Monday. So mark this on your Google Calendar that you want to go to tomwoods.com/blue and sign up for web hosting for your website that day, because you ain't never going to see a cheaper price for that from them. And then if you use my link, of course, make sure and contact me over at tomwoods.com, and I'll send you all the video tutorials that you need to get yourself up and running in no time at all. So those are the deals. LibertyClassroom.com on Black Friday. Rocket Languages, that's tomwoods.com/rocket. This is an unadvertised special so far, but you now know about it. And then finally, Bluehost, wait until, they're going to dangle $3.25 in front of you. Don't be conned. You wait for Monday when it's $2.95 and check it out through tomwoods.com/blue. Tomorrow we're talking about healthcare with a 20-year veteran of American emergency rooms, and boy, does he have a lot of stories to tell us about what's going wrong and what can go right in American healthcare. On Thanksgiving, Jordan Page will come back to the show to talk about a song he is releasing on Thanksgiving Day. And then finally on Friday, I can't remember what we're doing, but I know it's going to be super great. Thanks for listening. See you tomorrow.
Become a smarter libertarian in just 30 minutes a day. Visit tomwoods.com to subscribe to the show for free, and we'll see you next time.